Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look at markets, what they're doing this morning, and we're going to be looking at some of the key themes and market events that are in play this week and how they could potentially affect things. So let's jump straight into the charts, and I'll give you a bit of an update as to how markets are beginning the week, and then we can look at the calendar and have a bit of a discussion about that. So this is the S&P 500, or at least it's a CFD that tracks the S&P 500 futures, and you can see that it's about 1% up in pre-market trade. Monday. The market's just opened on Monday, but yeah, anyway, we're about 1% up. So very strong start to the week. Risk assets doing very, very well. Let me just show you. You've got cryptocurrencies also doing well. Look at this, Bitcoin above 24k. See if I can show you the stock 600. Might not be able to. Yeah, I can't. But anyway, risk assets enjoying a good start to the week. Why? Well, the focus appears to be on better than expected economic data out of the US last week. Okay, so we had the strong jobs numbers, we had the strong ISM services numbers, even the manufacturing number earlier in the week, it was still weakened, but was better than expected. And pretty much the takeaway from last week, all that US data, is that the US economy is not in recession and doesn't even look as though it's slipping into recession, at least not in the near term anyway. And yes, that has bolstered Fed tightening bets, okay? And you've also had some Fed speakers out over the weekend sounding hawkish and talking up the need for further tightening, more 75 basis point rate hikes potentially, just as they did last week, like throughout last week, and they will probably continue to sound hawkish because of this strong data. But the focus seems to be much more on the strong economic fundamentals as opposed to fears about Fed tightening. Because I think one of the things with markets is this: if markets deem that the economy is doing well enough to justify tighter financial conditions from the Fed, then it's not necessarily a bad thing when you start pricing in those tighter financial conditions. It's when you have a situation like we had for much of this year where the economy is clearly weakening, but inflation keeps going up. So you've got weaker economic fundamentals and a more hawkish Fed. That's like a kind of toxic combination, which we don't seem to have had last week anyway. Obviously, equities also still getting the help from the strong start to the earnings season that, you had all these big cap names and they were posting generally solid earnings and gaining. And remember, with the S&P 500, let's just go a bit technical. We've had this technical buying momentum as well since breaking above this long-term downtrend. And you remember, for a couple of weeks, I've been calling for us to test this area of resistance around 4,200. And look how close we are to it now. And, it looks like this week we can test it. Let's look at currencies really quickly as well. If it loads, there we go. You can see the Dixie falling a little bit this morning. Obviously, risk on markets tends to weigh on the dollar a little bit because it is seen as a safe haven currency. But the thing is the dollar going to see substantial further downside? Well, I don't think that's likely, because if the US economy is doing better than expected at the moment, which last week's data seemed to show, and if the Fed is sounding hawkish, which they have been recently, then those are all dollar positives, really. So yes, okay, maybe you're going to have risk on markets in the next couple of weeks, but I think if this is now the theme, decent US economy, still hawkish Fed, then you could continue to see the dollar grinding higher, and potentially we could get back above this 21-day moving average here, which is around 106.60. Something I'd be looking out for. What other asset classes can we look at? Let's look at oil real quick. This has been helping risk appetite recently, because obviously we've been so worried about inflation becoming embedded that when we see oil prices dropping like this, well, this very much fits in with the sort of inflation having peaked narrative. And this pretty much guarantees that month-over-month inflation rates We're about to get inflation data, by the way, for July. That's on Wednesday. That's the big event of this week. But, you know, if we continue to fall within this trend channel, then this guarantees that not only July CPI, headline anyway, the one that does include energy prices, and August CPI are going to be slower, or at least that's what you would hope for anyway. But yeah, like I say, the main event in the week, let me bring up the calendar actually, and we can sort of go through it. You can see I've filtered for events which actually have some impact. The biggie, US Consumer Price Index figures on Wednesday. We're looking for a slowdown, and we're looking for that peak inflation to have actually come in now. Okay, so yeah, look at this. Month over month, we're seeing drop into 0.2%, okay, from 1.3% in June. Core also seen slipping at slightly month over month. But as importantly, the headline year over year is seen falling back to 8.7% from June when it was above 9. So if this inflation data does come in as expected, then that's going to be good, because that is going to sort of underline this peak inflation narrative, which is going to be, you know, inflation's still going to be very, very elevated, well beyond the Fed's 2% target, but it is welcome news to at least see it moving in the right direction, because we've seen it moving in the wrong direction basically consistently now for like over a year. So we want to see this tide turn finally. And if that does happen, let's just go back to the charts and talk specifically about stocks. Come on. Why is it not loading? There we go, loaded. You know, if this inflation does come in, sort of building that peak inflation narrative, then I think we can get a bit of a relief rally on that. But anyway, we'll have to see about that. What else we got this week? So I think this University of Michigan preliminary consumer sentiment survey for August that's out on Friday is going to be important as well. We know that the US consumer is in pretty bad shape. These surveys have been telling us that for a long time. But I'm kind of more interested in the inflation expectations component of this survey, because, you know, inflation is a big story at the moment, as we've just been saying, and it has the ability to influence markets. Okay, so we want to see falling inflation expectations. That would be the positive for risk appetite. That would be what the Fed wants to see: inflation expectations falling back towards their 2% target. Okay, UK GDP as well. Last week, obviously, we had the Bank of England forecasting 5 consecutive quarters of negative GDP growth in the UK. So this is going to be the first estimate of Q2 GDP we get out of the UK. And look at this, we're expecting that actually the recession's already begun, minus 0.2. And then, yeah, no, New Zealand inflation expectations, that could always impact the Kiwi on like an intraday basis. But aside from that, monitoring the usual themes such as the energy crisis in Europe. But other than that, it's not the busiest week. But just, yeah, be on the lookout to see if this strong start to the week in terms of risk appetite can continue. That's it from me for this video. Hope you guys enjoyed it, and I will see you all in the next one.